Welcome back to the Retirement Planning MadeEasy.com show. I am your host, as always, Chris Hammond. And on today's episode, I want to talk about a tax reality that is confusing a lot of times if you don't see this every day or think about it. And why would you, if you don't do this stuff every day for a living? But it's this idea and this truth that not all your accounts are taxed the same way. Um, and I've seen this come up with people before, and a lot of times they can end up paying more in tax than they would have with some just a little bit of tax planning and tax planning advice provided to them. And the way I look at that, and this is kind of the reason I find all this so very important and why I try to help people out with this and putting out this, these shows and episodes like this is because the more that you pay in tax, especially if it was not necessary, if it could have been, lowered through just some, simple tax moves that could have been done. But the more that you pay, that's just getting you closer to running out of money in retirement because it's the less that you get to keep for yourself. And that's one of the biggest concerns that, I come across with people talking to me is that they want more security in retirement. They want to know that they're on the right path to keep as much of the money as they can. They want to make sure that they pay the IRS everything that they're legally obligated to. But if they're able to do things that are also legal with how they manage and take withdrawals from their accounts to keep them at a lower tax rate, then they want to do that as well. And I've seen situations where people didn't know the implications of what they were doing with, say, like a 401k, and they just cashed it out and they paid a higher tax. In some cases, they even set themselves up for a year coming up to where they had to pay more on their Medicare Part B premium because of something that they did 2 years prior on like a 401k. Just one example. So this is a really important topic. That's why I talk about it a lot. So today we're going to talk about how not all of your accounts are taxed the same way. And the reason is because understanding how the tax code works can help you to potentially pay less in taxes on your investments. And I'm talking about paying everything that you're legally obligated to pay to the government. We're not talking about any shystery type of stuff. But if you understand how the tax code works, there are things that you can do to pay them everything that you owe them, but not leave them a tip, so to speak. So let's kind of look at it on the three different types of accounts and how they are taxed. So the first account would be a taxed now account. The next one would be a taxed later, and then the third type of account would be a taxed never. Now, the taxed now account, these are what we would call non-qualified accounts. So if you have money just sitting in a savings account or a checking account at your bank, that's probably a non-qualified account. You can also have a non-qualified account that's invested in the market in a diversified portfolio with stocks and bonds in it. What it means by saying taxed now is that whenever you own those type of accounts, whenever you receive interest income, you're going to get a 1099 INT for that. You have to claim that interest income and pay a tax on it. If you get a dividend off of these accounts, if you have some invested in stocks that pay a dividend, you're going to get a 1099 for that as well. And you have to claim that as income every year whenever you receive that. Also, the tax now accounts, if you ever sell a position that has gone up in value, that's called experiencing a capital gain. And you have to pay tax on that capital gain depending on what your income level is. If your income level is low enough, you may not have to pay anything on that capital gain. If it's on another certain threshold, you may have to pay 15% on what the gain was. And then if it's up a little bit higher, you may have to pay 20% on it. So these are what we call the taxed now accounts. Every year when you have a gain on sale or you get interest and dividend off of that, you pay the tax now on that. And it's taxed at different rates. Like for an example, the dividend, it could be a qualified dividend or a dividend that's not qualified, and that's going to impact which tax is applied to that as well. So that's one thing. That's one type of account. Another type of account is called the taxed later account. So this is something that you would be familiar with. You typically think of it as your IRA, your 401k. If you're a federal employee, maybe it's your TSP. These are taxed later accounts, which means that the money that you put into it, you got a tax deduction in the current year when you put the money into it. And the money then grows tax deferred until later is what we're talking about here. And when you pull that money out of that account, you then get taxed on it. And it's typically going to be taxed at your marginal income tax bracket, not the more favorable capital gain tax rate. So depending on where you fall on the income tax bracket for the year that you pulled the money out, that's what you're going to be taxed on. Now, that's the rate that you're going to pay for that. So if you had really high income for a year and you pulled money out of your IRA or your 401k, you may be in a higher tax bracket. Or if you think that tax rates are going to go up in the future, um, you may be pulling money out in the future, and tax rates could potentially be higher than when you put the money into it and got the tax deduction in the current year. In that case, it probably is not going to work out as good in your favor for having that tax deferral in the current year. But these are the taxed later accounts, and they are taxed differently than the taxed now accounts. And then you have the taxed never. And when I say taxed never, I'm talking about the growth inside of these accounts. So let's think of like a Roth IRA or a Roth 401k or TSP. Think about those. When you put money into it, you already had to pay tax on that money. You don't get a tax write-off, okay, in the current year that you put money into it. But if you follow the rules, whatever that money, that Roth account grows to, when you pull the money out, if you follow the rules correctly, you're not going to pay any tax on the growth that's been in that. These are the Roth accounts. So they are not taxed. So that's obviously different than the taxed now accounts and the taxed later accounts. So those are your three types of accounts and how they could be taxed and how it could be different. Now, the key takeaways, because that's just kind of information, the key takeaways, though, of where you want to consider and how you could apply using this in your own situation is that diversifying your portfolio amongst these three types of accounts can oftentimes help you manage your taxes in retirement. I'll go back a slide and give you an example. So what I see a lot of is that people have a concentration of their wealth and their retirement savings in that middle column. If you're watching this on YouTube, if you're listening to the podcast, the middle column is the tax later account. It's the one that like people go to work for an employer and over time they contribute funds into that 401k and they get the tax deduction in the current year as they contribute money into it. But when they retire, a heavy concentration of their money is in these taxed later accounts. And what that means for them is as they're pulling money from these accounts in retirement, they're having to claim it as income. And not only, especially if these numbers get up into higher significant ranges over 1.5 million, 2 million, especially if they're single too, maybe they've gone through a divorce or become a widow or whatever it is, they're going to get to a point where the IRS is going to force you to take money from these accounts. They're called required minimum distributions. And sometimes those distributions, if the tax later account is big enough, that distribution itself that you're forced to take and claim as income can have an impact not only on the tax that you're going to pay on that distribution, but it could also possibly have an impact on the tax you pay on your Social Security as well. Right. So it's just more money that's going to go to Uncle Sam. And like I was sharing before, the reason it's so important to me is that the more that you unnecessarily have to pay because of less than optimal tax planning, it's just a little bit closer that it gets you to running out of money in retirement. All right. So I see a lot of that in the tax later account. Whereas if you diversify amongst these three accounts, then you can have more flexibility on saying, okay, I can pull X amount of dollars from that 401k or that IRA right now, and that'll keep me under this bracket. That'll keep me under this threshold to where I don't have to pay a higher Medicare Part B premium. All right. And the other funds that I need, maybe I'm going to pull them from my Tax Now account because I'm in a favorable capital gains tax rate, and I can take a few dollars out of that, sell some stocks at gain. Maybe I don't even have to pay a capital gains tax because I'm in the 0% bracket for that potentially. Or maybe I need to pull money from my Roth account because it's all tax free if I follow the rules, all the earnings inside of it. That's what I mean by that, the diversifying amongst these. So that's the first key takeaway. Now, the second one is this planning to diversify amongst all three of these accounts can take time. So you don't want to just like, if you have $1 million 401k, you don't want to just go in and say, I'm going to convert 100% of it into a Roth IRA, claim $1 million as income, and now whatever's left is now tax free if I follow the rules right in my Roth account. Because doing that is obviously going to push you in the immediate term into a much higher marginal tax bracket, whereas you may would have been better spreading that out over time, saying I'm going to convert 50,000 this year, maybe 50,000 next year, and I'm going to keep myself under certain thresholds that are more favorable to me. And even the money that is still remaining in that taxed later account, that 401k, maybe I've got the balance down low enough that when the IRS requires me to pay distributions out of it once I've reached certain ages, maybe those distributions now aren't so high. Maybe they're not going to cause me to have to claim so much income because over the years, I've been converting a little bit here and there into a Roth, for instance. This planning takes time to do. That's one of the big key takeaways from this. It's not something that in a lot of cases you want to do all in one fell swoop. It could be very bad for you. Um, the third takeaway is that doing this proper tax planning like this that helps you to lower your taxes, it just helps your money last longer. It means it's more that you get to keep. One of the biggest concerns that I see people share with me is that they're worried about running out of money in retirement. And the more your expenses are, the higher those expenses are, the more likely it is that you would run out of money. One of the biggest expenses that a lot of retirees will pay in retirement is taxes. You never reach that age. There's no age like in the Internal Revenue Code where it says once you reach this age, you no longer have to pay taxes. You never outgrow that. You never outage that. And one of the biggest expenses is going to be taxes for a lot of retirees. So the more that you can do proper planning to reduce that, then that's just more money in your pocket. That's longer your money lasts because you have to look to your own interest. You have to look to making sure that your retirement is funded. And you have to do that in a way where you pay everything that you're obligated to pay to the IRS, but not leave them a tip just due to some less than optimal decisions that you make with your accounts. Now, doing that requires looking at your, how the tax code changes every year, how the brackets change, and that may be a little overwhelming for you. If it is, then this may be something that you want to get some outside help for. You can talk to a financial advisor on that. That can help you with this. Really important when it comes to looking at ways to reduce what your legal obligation is and tax that you have to pay, and being able to keep more of your money and doing the right thing for your own future to help you to not run out of money. But if it's overwhelming for you, then seek out that help from somebody that does this on a regular basis for a living. Okay. Well, that's all I've got for you for today. If you're looking for some additional help and some foundational help on planning for your retirement, feel free to head on over to my website, retirementplanningmadeeasy.com. There you can download a free copy of my essential step-by-step retirement guide, which will give you some foundational information that you can start using and seeing how to apply it to your own situation. That's all I got for today. I'll see you guys on the next video next week. Bye for now.